afternoon, I'm Jennifer Christian and I work as a portfolio specialist in the investment management team, and I'm going to provide you with a brief overview of this week's market summary. As the coronavirus spread beyond Asia, the sell-off in equity markets did as well, with the FTSE 100 falling just over 11% during the week, while in the US, the Dow Jones fell over 12.36% and the S&P 500 nearly 11.5%, the most since 2008. Now this compares to a typical MyWealth portfolio, and our client portfolios can be slightly different. And the cautious portfolio fell 5.19% over the week, the balanced portfolio fell 8.29%, and the adventurous portfolio fell 9.71%. Now concerns that the spread of coronavirus will impact economic growth also pushed the oil price down 13.55% to $50 for a barrel of Brent. Although we aren't trying to make light of the horrible human tragedy, for global equity markets, the coronavirus is likely to be a transient worry, just like SARS, swine flu, Zika virus and Ebola, as the central long-term fundamental growth drivers of technology and innovation remain in place. Now, with that in mind, back in 2011, we wrote a newsletter article titled "A Crisis is a Terrible Thing to Waste," after global equity markets were impacted by higher oil prices, the Fukushima nuclear disaster, and higher Eurozone interest rates. And after this week, which has been incredibly difficult for global equity markets, this quote, which is credited to the economist Paul Romer, has become very relevant today, as we believe that this week's sell-off has been emotionally driven and, as a result, indiscriminate. Yes, the coronavirus outbreak will undoubtedly result in slower consumption and investment, which will be exacerbated by the fact that China's economy has been in standstill for the past month. However, thanks to continued US consumer confidence, which hit a 6-month high this week, the outbreak is most likely to result in nothing more than a short, sharp shock and a potential mild recession, rather than a severe and protracted global downturn, which equity markets appear to be expecting and pricing, especially as we expect the Fed will act preemptively and cut US interest rates at their next March meeting, as the best way to combat an economic downturn is, of course, to avoid one. Now, this does not mean that we aren't concerned about the spread of the coronavirus. We are, and given the rapidly evolving and fluid situation, it is receiving our full attention, especially given the coronavirus-related company profit warnings that have started to gather pace. However, activity in China is now starting to return to normal, and this is positive news, as this should start to alleviate the supply chain pressures that have led to these profit warnings. So while we appreciate that both the coronavirus and the resulting equity market weakness is unnerving, it is very important to maintain a long-term perspective and resist the urge for any knee-jerk reactions. And given this week's indiscriminate, emotionally driven selling, it may not require much good news for global equity markets to rebound both quickly and strongly. In fact, we believe there is a reasonable chance that we will see a V-shaped recovery in equity markets as soon as we get greater clarity on the spread of the coronavirus and, of course, the current fears dissipate. Just as the Chinese equity market has done, now coronavirus cases have peaked. As you can see from this chart, while still down, Chinese equities have rebounded strongly and are now well above the bottom of their virus-induced sell-off. There will always be periods of market uncertainty and volatility, and this is no different. But at MyWealth, we take a long-term approach to investing because evidence shows that this leads to better outcomes for our clients, and we believe that time in the market is more important than trying to time the market. In fact, history is littered with periods where equity markets have fallen sharply for a couple of days or weeks. Market shocks always tend to be greater on the downside than on the upside. For example, if we look at the infamous Black Monday stock market crash in October 1987, when the FTSE 100 fell over 22%, or 10 years later in October 1997, when the FTSE 100 fell over 9% due to the Asian stock market crisis, While both of these periods were very scary at the time, they now look like small blips on a long-term chart. Now, as long-term investors, we currently see plenty of opportunities to make long-term gains, as equity market panics are almost always the best time to invest. And we believe that we have reached that point as the current sell-off and weak market sentiment appears to be feeding on itself. Now, while economic data doesn't really matter in emotion-driven equity markets, looking ahead to this coming week, we have Chinese PMI, which will no doubt show that their economy has been hit hard, US employment data, and Eurozone CPI, which is likely to slow further as the oil price has been weak due to the coronavirus. On a final note, we'd like to remind you that we are approaching the end of the tax year, and if you have not yet taken advantage of your ISA allowance, now's the time to act. The current limit is £20,000, and if you don't use it by the 5th of April, you will lose it. Contact us using the details found in your email to start the process. Now that's all from me this week, and don't forget, if you haven't already, you can also read a more detailed insight into matters affecting the markets in the email.